Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Geopolitical news front and center again today. The Ukraine carries out first strike with U.S. missiles in Russia. And then we had some rhetoric coming out of the Russian foreign minister down at the G20. Really spooky markets. Marc Champion joins us. He's a columnist for Bloomberg Opinion. He's located in London, and he is one of our resident experts on geopolitics, particularly in that part of the world here. Marc, it just feels like today was not a good day for the folks that were looking to try to move towards a resolution there in Ukraine. What's your latest view on what's happening in that part of the world?
Yeah, I mean, the kind of trajectory we have is that the Ukrainians are very much on the back foot on the battlefield at the moment. They have been for some months. Obviously you have a new U.S. president coming in who says he wants to end it all in a day. But the question is, at this point, everybody is agreed, including Volodymyr Zelensky, that this needs to come to an end next year. The question is which day and which end of the year. How do you get President Putin to the negotiating table as opposed to just offering to accept Ukraine's surrender? In the current circumstance. So what the Ukrainians want to do, what the Biden administration seems to be, trying to help it to do, is to change the facts on the ground such that, Putin will have some incentive to actually negotiate.
Well, I was going to say, who has the upper hand at this moment?
Well, there's no question. The Russians do. They're moving, every day. They're moving forward along the front lines. And it's not a collapse. It's not a kind of sudden, end of days. But there's no doubt about which side has the initiative at the moment. That has kind of flipped from one side to the other, throughout the war, and it could flip again. But at the moment, the Ukrainians simply lack the number of personnel, the manpower to do it. They were late with mobilizations, and they are in a pretty bad state. So what they're asking for is different ways of helping them so that they can stabilize the line, perhaps even change the momentum a little bit, and then importantly strike behind the Russian lines to increase the cost of continuation for President Putin so that he actually has a reason to say, okay, I'll talk.
Between now and Inauguration Day, it seems like a time period where each side will be trying to just improve their position with the understanding that it looks like, whether we want to or not, we're going to the negotiating table. Is that kind of the view?
Yeah, I think that's exactly what's going to happen, and that's the context in which to say to look at the sort of Russian sabers rattling again on the nuclear issue at the moment. I mean, the reasons for not pushing the nuclear button have not changed, and there are real hurdles and costs involved in doing so. President Putin didn't do that when Russia was losing on the battlefield, and he's very unlikely to do it when they're winning. But it does tell you that he's trying to shape what the U.S. in particular does between now and next year. And this is one tool which he has to do it. He has others. Yes, absolutely. Both sides will be trying to maximize their position for when they actually have to make some kind of deal.
And does that deal, is that contingent on, say, President Trump, or you think regardless of who's in the White House, this is the way it was going?
It's going to probably get there faster because of the arrival of Donald Trump. But yes, that's where it was going. Zelensky. If you look at Zelensky's victory plan, which is often misconstrued, if you actually read it, he's got a 5-point plan there. None of them talk about territory. None of them say we have to get Crimea back or we have to get this back or that. It's 4 points which are just about security. How do we secure Ukraine to make sure that when we agree to a ceasefire, it's just not a little interlude before the Russians attack again. and then a final one, which is a sort of, just a bid to interest Donald Trump in particular, but the West in general, in what they can get out of helping Ukraine in terms of resources and so on.
All right, Marc Champion, thank you so much. We really appreciate getting your thoughts there. Marc Champion, he's a columnist for Bloomberg Opinion, joining us from London via Zoom, giving us the latest thoughts on Ukraine. Again, the thinking now is perhaps in 2025 that might be a period for some type of truce to come to that part of the world. We'll have more reporting on that.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
This is Bloomberg Intelligence Radio. We are broadcasting to you live from our interactive broker studio right here in Midtown Manhattan. And we want to know, what would you like to hear about on Bloomberg Radio? This helps make shows like ours even better by taking our Bloomberg audience survey. Visit youtube.com/Bloomberg Podcast and click the link in our profile or community section to take the survey, which is hosted by our partners Material. Fill it out now at youtube.com/Bloomberg Podcasts. All right, let's get back to the market here. So we may have some geopolitical risk shaking in the market, but if you take a look at some of the equities like a Walmart, still holding up fairly well. That stock now around the highs of the session, up almost 5%. Joining us now to discuss is Emily Cohn, a Bloomberg Consumer Team Leader. I mean, she heads all the stuff of consumer stocks. She joins us now in studio. Emily, wonderful to see you.
Thanks, Alex.
What do we make about the reaction to Walmart stock? Because consensus was already high. The stock had already moved. Like, we kind of knew it was going to be good.
So when you think about Walmart is a bellwether of the American economy, of the American consumer. What does Walmart earnings tell us about that? Walmart beat expectations today, sent a really strong signal that the holiday season is off to a solid start, and the market was excited about that. The growth in the number of transactions or checkouts slowed, the growth rate slowed a little bit. The average ticket, the amount people were paying in each checkout was up. And a lot of that growth was coming from higher income shoppers, people in households making more than $100,000 a year. That cohort made up roughly 75% of the share gains. So this was good. It was a solid start to the holiday season, and the stock is up a lot. 4.5% is up a lot for a company that big.
Stock's at all-time high, of 67% year to date, which I had no idea. Their e-commerce business. Talk to us about their e-commerce business. I know it's big, but Amazon's pretty big too. So how do they talk about their e-commerce business?
When they talk about e-commerce, they just talk about the potential to grow. It is big, but there is still so much room to grow. So just in the last couple of months, we saw them branching into categories that you wouldn't find in a typical Walmart store. Pre-owned watches, collectible sneakers, stuff you would typically go to another retailer for, but now you can buy at Walmart online. Also, they're adding benefits to their services like Walmart Plus. You can now get discounts of Burger King if you're a Walmart Plus member. So they're really expanding their offering there. Deliveries can get faster, and they see just endless potential there. It's always growing.
My question I had before the break was those people that make over $100,000 or more, are they sticky? As in, once the economy, say, recovers, or once they feel better about inflation, or et cetera, do they flee then to go to Target or somewhere else, or go to the fancy drugstore, or do they stay at Walmart?
I think that's a really good question, and something we're definitely watching for. Spending across the board at Walmart was consistent. The growth, as you said, was coming from these wealthier households. Maybe it's a shopper who typically shops at Whole Foods, but is feeling particularly pinched right now and is going to Walmart for value. Do those people stick around when they get a raise in their next paycheck or their paycheck in the next couple of quarters? That's something we're definitely watching for. I think it does have limits.
So are they still opening stores? Isn't there a Walmart pretty much in every town USA these days?
It's a good question. I think when they talk about growth now, they're talking about e-commerce growth.
Yep.
I think that's where they see the highest potential for growth, and they need it to get profitable. That's something we heard the CEO talk about today. Not that they're racing to it, but it's a long-term game. They want their e-commerce division to get
So are they feeling pretty okay about a holiday shopping season? Because
Yeah,
we're smack
holiday-
bam in it. Not that I've
Right.
shopped yet, but I mean,
Yeah, holiday shopping is off to a strong start. So the interesting thing about the holiday season this year is that it's shorter than in most years. Thanksgiving is following later in the month of November. So the answer to that is that they trigger the deals even earlier than usual.
I can see all the sales coming in. Paul knows that I shop on the sales. Let's go to Lowe's, because that is interesting as well. That stock is off the lows of the session, but still down over 3%. What did Lowe's say?
So Lowe's shares fell before the bell, and quarterly comps were better than expected, but still declining. So high interest rates and a weak housing market means people are moving less than they were before. It means they're spending less on big ticket home renovations. But despite gloomy sales, Lowe's actually raised its forecast for the year, seeing positive growth in its professional business, so selling goods to contractors and builders, also in e-commerce, and spending on smaller ticket outdoor projects. Last week we saw Home Depot similarly say that the weather was actually a bright spot for its sales. So the hurricane led to higher sales for Home Depot. Warm weather meant that people were spending more on grills because the grilling season was getting longer. So in general, for these Lowe's, Home Depot, sales are down, but the outlook got a little bit better this quarter.
where do we see the weakness in the consumers? Is it like in the dollar stores? Because I mean, again, I see a strong number from Walmart. To me, that is America. So where is the American consumer hurting? Is it? I guess it's even at a lower end than Walmart.
Yeah, the lower end is definitely suffering. The dollar stores are suffering. They don't offer the variety that Walmart offers. 60% of Walmart's business today is in groceries, and you can get some pretty good stuff at Walmart these days. Yep. Gluten-free items and organic produce and stuff that you're not going to necessarily find at your dollar store, and that's really, really helping them, especially when it comes to growing an e-commerce business where people are looking for a one-stop shop for everything.
So before we let you,
I have a gluten-free friend. And it's a thing.
Good job.
It's a thing.
It is a thing.
I have multiple gluten-free friends.
I didn't know it was a thing.
Oh,
but
it's
now
a thing.
I've been educated.
You've been educated
Yes.
for that one friend.
Yes.
Before we let you go, we got a lot of retailers out this week as well. What are you going to be focusing on in the consumer trends land?
Definitely the holiday season. What are people seeing? That's the big question this year. Are people spending as much as they usually spend? Are they buying as many gifts as they usually buy? Also Thanksgiving for the grocers. I think a lot of people are just worn out from paying really high prices for food. They're also worn out from cooking a lot more than they have been since they're eating out less. So how is that showing up in consumer sales? Definitely trying to get a sense of how the consumer is feeling about what is the most significant shopping season of the year.
I know my husband's getting a little burnt by all the cooking he's doing. I'm really good at ordering takeout. He's the chef in the family. All right, thanks so much. I really appreciate it. It was wonderful to have you, Emily Cohn, joining us. She heads consumer trends coverage for Bloomberg News.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, taking a look at the markets again, we get the S&P is down by about 4/10 of 1%. The Nasdaq off just slightly. What do you do in the market when there is a slight safe haven bid? I say slight because we've definitely backed off some of the levels that we've seen earlier in the session. Chris Watling is CEO and Chief Market Strategist at Longview Economics, and he's here in studio to discuss his latest calls. Chris, we're getting all the 2025 calls out now. Everyone's looking pretty bullish, but the bear case and then the bull case seems to be super wide. What are you guys modeling right now?
Well, I think what's really interesting is what we're seeing in terms of the global economy next year. When you sort of whip around the world, you look at China, you look at Europe, the UK, and the States, obviously, with its new government, there's all sorts of stimulus coming. I mean, if you look at a raft of 90 central banks around the world, the vast majority of them are cutting, and they're in cutting mode. Very few are raising rates. That's normally a very good environment for equity markets. So tons of stimulus, lots coming. Yes, there's a lot to worry about. That's why you get those wide ranges on those forecasts. There's a lot of left of field with the new administration, and one's got to think about those tariffs and the like, and appointments still to come. So one doesn't really know how that's going to play out. But I generally think that the thrust is good, and bizarrely, we could actually, absent those risks, we could actually have a year where volatility falls. And sort of go, you remember 2013 or 2017, volatility collapses because everyone's cutting rates. There's a lot of liquidity around. So I can't get my L's out there. But
We got you.
So in that kind of environment, long stocks, my long credit, how do you think to play it here?
Well, I think your long equities and your long bonds, bizarrely. I think government bonds are oversold. And actually, I mean, I know the data's distorted today, but housing's just struggling. You know, there are parts of the US economy that need lower rates to get it going. And the fiscal impulse is dying as we go into next year, and we'll have to wait until you get another fiscal package, and we don't know what the size of it will be. So I think long stocks and long bonds, and you want to play the cyclical parts of the market, which I think, you know, when you get that cyclical reacceleration, that's a great place to put money. So Mag 7 dominance is slowly dying, in my opinion.
But then on the flip side, you'll say, I'll hear things like, yeah, but retail sales are holding up, the job market's still holding up, inflation's still holding up, so maybe we're not going to get the kind of rate cutting cycle that we might expect.
Well, yes and no. I mean, inflation, in my opinion, is dying. I mean, this was a classic monetary surge of inflation. People like to compare it to the 70s, but there are much better comparisons going further back, where M2 surges and then M2 collapses. And that's really what we've had. And that's the kind of inflation outcome we're going to get, where inflation is going to dissipate. So that'll encourage the Fed, I think, to do a little bit more than people expect.
The event tomorrow, presumably, just on the earnings front, will be NVIDIA after the close.
I was like, what event?
Yes,
yeah, I forgot.
we've kind of got it with NVIDIA. We've been talking about it since, earnings season began, 4 or 5 weeks ago. How important is that? Because it seemed like for 2023, for most, if not all of this year, the AI trade has been powering this market. And it feels like maybe it's fading a little bit, but how important is NVIDIA tomorrow to you?
Well, NVIDIA is important, but it is only one stock.
Yep.
I mean, it doesn't feel like only one stock. It feels like
Right.
the whole market. But it's only one stock, and really the Mag 7 has become the sort of Mag 1 or 2. So there's a limit to how much the market can be powered high by a couple of stocks, and I think that's the point. And the other thing about NVIDIA is, the second derivatives of earnings growth is slowing. So it's kind of, when stocks like that, you need the first derivative to be fast. And that's now slowing. I wonder if margins are toppy. So, I think Mag 7 as a whole is toppy on margins. NVIDIA, of course, is exciting, but I don't think it has the influence it had last year.
So based on that, and then you talk about the rate cutting cycle really being front and foremost in sort of how you view the market, is that an ex-US equity situation, or is that a US or is that just a US?
So I think it's a global cyclical trade, and of course the large cap US is dominated by Mag 7. So I think what we'll find is they've become a source of funds to buy into cyclical parts of the global stock market. So in the US, mid and small caps, some of the cyclical areas of the market for sure. People talk about financials, tick. But outside the US, tons of stuff. There's so much cheap stuff that's cyclical. We're going into sort of nominal GDP growth. This is all good for those parts of the world. We like the UK. We like Spain. Bizarrely, sort of no one's talked about Spain for a long time.
Why do you like Spain?
Because Spain spent 15 years getting its house in order. And Germany's the sick man of Europe, which means rates are lower in Europe than they otherwise would be, and Spain gets cheap money. So it's a lovely little combo. And Spain's doing really well this year. There's four out of 50 countries in the world that are more than 50% discount to the US, and their earnings growth are faster over the last few years. Places like that are going to do really, really well. Greece is one of them. I mean, who talks about Greece?
Nobody talks about Greece. But that's on an equity side. So for Spain and Greece is on the equity side, not the bond side? Or
that's
both?
all the equity side,
okay,
absolutely.
Okay.
Bonds, fine. US bonds, great.
So, exactly. All right, so you woke up 2 weeks ago in London, saw that the Americans elected themselves a new president. We now know how the Congress is going to look like. Did that change your view at all about how to invest?
Well, at the margin, potentially, you get a bit more fiscal and a bit less sort of consumption growth out of the States. So there's a bit of a risk at that. But actually, it made me feel more bullish. I'm apolitical. I'm a Brit, so I don't vote. It's nothing to do with me. But looking at it objectively, it seems much more pro-growth, with the exception of the tariffs risk, basically. So yeah, it made me more bullish, cyclical stuff.
But I guess what it does matter is the fiscal side and the fiscal policy, in which case, where do you invest in small caps, say, or mid caps?
Well, I think the consumer's going to do well. There's untapped wealth in the US and the UK and Southern Europe. And so I like consumer cyclicals. And I think bonds are coming down, so I like housing-related stuff. So all of that I think is good. I'd be cautious on the biotech because there's all sorts of policy changes coming around the corner. But yeah, I think there's a lot to go for in the mid and smalls.
All right, Chris, it's always good to see you. Thanks for coming by. Great to see you in person. Chris Watling,
Thank
CEO
you.
and Chief Market Strategist of Longview Economics. I read their weekly report every Friday.
Nice, good.
Really at 11:30 in the morning. But I'm focused. It's just
Okay.
on commercial break. You know,
Okay.
you gotta stay current on
Got to
that.
stay engaged.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm Alix Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies in 130 industries worldwide. And here is one of the best of them, Mandeep Singh, Bloomberg Intelligence Senior Tech Industry Analyst. He joins us now. A lot of things to pick about here. Obviously, NVIDIA tomorrow, definitely part of the story. But one is Google, and the DOJ pushing Google to sell Chrome to break up its search monopoly. How seriously do we need to take this, considering there's going to be like a new White House and a new DOJ in a few months?
Yeah, look, I think it's still uncertain who President-elect Trump is going to appoint to run the agency. And a lot depends on how hard they want to go against the likes of Alphabet and Meta. But in this case, the fact that DOJ is proposing, and we know the vice president-elect, he is not opposed to, breaking up these big tech companies. So clearly it is a risk. And I think when you look at what they're proposing, breaking Chrome, you could argue there are independent browser companies out there like Mozilla. So Chrome could exist as an independent company, but it's very hard to see how you can make a business model out of Chrome, and then it does hurt, Google's engagement. In the end, this is the distribution for Google, owning the Android operating system and owning the browser. You take out the browser, their distribution for search goes away. I mean, Google search will still be the dominant search engine, but in the internet world, it's about owning distribution. That's why Apple has so much cloud. That's why, owning Android and Chrome are the crown jewels when it comes to Alphabet as a franchise.
So Mandeep just painted us a pretty dire picture there. Guess what? Stock's up today. Why? Because people like Jen Rhee, who covers litigation for us, this is her sense. I know you didn't write this, because I know her writing. If Alphabet were forced by the DOJ to sell its Chrome browser, which we view as unlikely. So that's kind of the takeaway there. So when Jen Rhee tells me it's kind of unlikely, but still, I guess we have to expect, or I guess Google investors have to expect some types of modifications to their behavior in their business models. But I guess on the margin, the market's saying it's not going to be that material.
It's reflected in the stock. In the end, it comes down to what is the valuation right now, what is baked into the stock, and all the bad news around regulation is in the stock. That's why Alphabet is not trading at 30 times earnings. It's trading at a discount to the likes of Microsoft. So, look, I think they will have to make remedies, even if it's not a forced divestiture. They're already starting to pare back when it comes to ad targeting, how much data they mix and match across their family of apps, whether it's YouTube, Maps, Search. So from that perspective, I think they are going to try and do these measures on their own. And, just to convince the regulators that owning the browser is not something that gives them an advantage. And maybe they have to expose the data that they are using for targeting the users when it comes to ads. That's the other part of the remedy here.
And this just means like then they're getting ahead of it, right? Then they're getting ahead of anything that may come from DC or Europe at any time, in essence.
Yeah.
What are you going to be looking? Can I go to NVIDIA now? It's been 2 minutes. Okay, great. So tomorrow, NVIDIA. What am I looking at?
I mean, there's so many things when it comes to the continuation of this Gen AI wave. This is the bellwether company. And look, when it comes to data center spend, it's all about how scalable the models are going to be in terms of, whether it's ChatGPT or Google Gemini, how big of a cluster they want to create for next year. Because right now, everyone is looking at the compute that OpenAI has used for GPT-4, and they're saying they already have a trillion plus parameter model. Can it get any bigger? The answer from NVIDIA is yes. We are giving you a more powerful chip, and you can create a bigger cluster next year to train your models. So if that's the case, then the compute requirements continue to scale up, which is what they are betting on in terms of the data center upward revisions we have seen the whole of this year. And they think the scaling of the foundational models is going to continue. The moment you hear about a plateauing of the foundational models, that's when you're not going to see the upward revisions we have seen for NVIDIA's data center revenue.
NVIDIA stock is up 3% today, up 190% year to date with a $3.5 trillion market cap. Dan Ives from Wedbush Securities was out with a tweet this morning saying he believes that they will beat on revs by $2 billion and take their guidance up by another $2 billion. He calls that the drop the mic.
But that may not be enough to drive the multiple. See, that's the thing.
It's 50 times forward earnings. You're right.
What is reflected in the stock? In the case of NVIDIA, last time around when they reported earnings, the stock had a 15% downward draft because everyone had such high expectations that even though they had a beat and raise, it wasn't enough.
That's a tough game to play, man.
Yeah.
But you came in here probably 6 quarters ago and said, as long as they keep doing it, the stock will keep working. But at some point, with that quarter's going to come where they're going to.
Yeah. Because it's not recurring revenue. Yep. And in the end, the moment you're talking about digestion, okay, we have had enough in terms of scaling. Now we are focusing on inferencing and deploying this. We're not getting the bang for our buck when it comes to scaling the models. That's when NVIDIA has to find another way to keep driving the growth.
All right, Mandeep, we appreciate you and good to see you. Thank you so much, Mandeep Singh. No doubt we'll see him every day for the next few days. He's Senior Technology Analyst over at Bloomberg Intelligence.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix Steele and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well, so head over to youtube.com and search Bloomberg Podcast, and that's where you'll find us. David Bahnsen joins us here. He's the Chief Investment Officer at Bahnsen Group. They have about $6.5 billion assets under management. David, thanks so much for joining us here. You woke up, 2 weeks ago almost. We have a new president in the White House starting January. We're going to have a new Congress as well. Did that change your outlook, your investment outlook at all?
It did not, in the sense that the primary things that drive markets we felt were not going to move a ton, which is around the earnings profile, earnings expectations, and the monetary policy. However, within the weeds, it reinforced our optimism in the energy sector, which has certainly been very validated over the last couple weeks, and the financial sector. That was an area where we thought policy would make a difference, and particularly some of President Trump's policies more favorable in those two sectors, and Vice President Harris is less so.
From the earnings perspective, you mentioned earnings obviously driving stocks here. We're just kind of finishing up with some of the retailers this week. What is your view of the earnings profile of this S&P 500 these days?
I think that the earnings profile is obviously very good, and that the growth of earnings next year is very good, and that is fully and completely priced in the market. And so the risk is really very little that earnings disappoint. I mean, that's always possible. There's always issues that could disrupt expectations. We happen to have a very, very good track record in our financial markets of being able to project earnings. However, you're paying 22, 23 times next year's best case earnings right now. And so I find that problematic.
So where else would you go then if that feels too expensive?
We would not buy the entire index, especially where it's cap weighted, especially where a lot of the big tech names that are big profit earners are trading at over 50 times. And if you're looking at trailing earnings, they're trading at 70 or 80 times earnings. Therefore, you have to be more selective, and we're more value biased at our firm and very dividend growth oriented. But some of the healthcare names, some of the financial names I mentioned, energy, right now, if everything goes perfectly for Mag 7, it's about 21% of next year's earnings. It's 33% of the S&P. Financials are the only two sectors. Earnings projections are more than what they represent within the S&P. So we just recommend people be more bottom up right now.
All right. So within, let's say, energy, for example, where in the energy space are you seeing opportunities?
Very, very heavily in midstream. And that's kind of interesting to say because it's had a heck of a year. And really since November of 2020 has had quite a great tear, but it was doing so from just decimated prices out of COVID. Now, not only have the pricing environment and the psychology and investor sentiment got better, but the fundamentals are dramatically better. Way less debt, way less leverage, way more cash flow coverage, and certainly right now a policy you can see from the new Secretary of Energy coming in, the Secretary of Interior, there is a philosophical bend that is pro our ability to get permits for new oil and gas pipeline and to export LNG. These two things are huge growth sectors.
Yeah, meaning that you can actually put a shovel in the ground to build a pipeline maybe.
That's right. And so what you have right now is a lot of value in the current pipelines because they're all we have. And then now you get the opportunity to build new pipelines, which I think adds to the growth profile of the sector.
So, Dave, how about in financials here? I mean, do you stick with the JP Morgan's, Goldman Sachs of the day, or do you try to get a little bit more specialized?
Well, so we own JP Morgan and have owned it since March of 2009, and it's one of the most profitable investments we've ever made. And we have had to tick down our weighting a little bit because it has just done so well, but we're not abandoning it. They're the cream of the crop, and there isn't another big bank we want to own. We also own, as far as big commercial banks, Morgan Stanley is the name we own, not Goldman Sachs. They're actually both fantastic companies, great brands, great franchises. It's just the dividend growth. We think Ted Pick, the new CEO at Morgan Stanley, I joke he's the person in America second most passionate about dividend growth, with myself being first. And we think Morgan Stanley's got a great fee-oriented business that's much less lumpy, much less dependent upon institutional securities and investment banking versus Goldman Sachs. Their wealth management and asset management are really annuitized at Morgan Stanley.
Hey, David, we really appreciate it. We always love your perspective on this. David Bahnsen, Chief Investment Officer at the Bahnsen Group. Thank you very much.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
One of the best performing stocks in the S&P today, yesterday, you name it, is Supermicro. Here with the latest is Jin Ho, Bloomberg Intelligence Senior Technology Analyst. So the latest is BDO. That's going to be their new auditor. That's not like a giant, huge name, though, right? Are you disappointed in the name, or is it just the fact that, hey, they have someone?
Yeah. Hey, Alix. Thanks for having me on. The fact that they actually got an auditor, given what they've gone through over the last 2-3 months, is actually positive news for them.
Wooj, when I kind of just look at this story, again, they've had some real concerns with their auditors and some of the auditors' concerns about the risk controls, I guess, at the company. Can you give us your opinion of management of this company and the board of this company?
Yeah. One of the reasons why E&Y resigned as an auditor as part of the 8K filing was that there were some integrity issues that they found as part of trying to get some financial documents. Paul, I haven't seen the word integrity issues in an 8K filing or an auditor resignation since back in the Enron days. I'm not saying that this is an Enron, but this is something that you don't typically find in a filing. So, I have called for, you may need an overhaul of the board or greater independence and possibly change of the CFO because this is not the first rodeo of having delayed filings.
Do you feel like the stock move is justified, or does it have more to go? I mean, I'm taking a look at the move in the last couple of days, and it's tremendous, but if you look at a one-year chart, this move is a pittance.
Yeah, so if we think about the recent moves, there's actually been more headline risk that's been driving the stock than the fundamentals. I think much of this is more of a relief rally that they're not going to get delisted. Now, delisting would have meant a couple of things. First of all, they get delisted, and it is going to start some forced selling. But it also would potentially, well, it would have forced the removal of the S&P 500, which would have been another round of forced selling when the rebalancing comes in December the 5th. So that eliminates that risk for Supermicro, so there is some relief there. But they're still not out of the woods.
Where does this company fit into kind of your part of the tech stack, Wooj, in terms of being a supplier of, hardware and components and things like that? Because, I mean, it's got $25 billion of, I guess, revenue. I'm just looking at the FA function forecasted for June 25. I mean, it's a big company.
Yeah, look, it's all about AI. I'm in Atlanta today for an AI conference, and quite frankly, Supermicro is going to take a prominent role at this conference to get customers. The question I have is how reliable are those estimates? Keep in mind, there's been several coverage suspensions, and I don't know how up-to-date those estimates are.
Who are the customers for Supermicro?
Yeah, so we do know that there are a couple of large, there's one large cloud customer, which we suspect is Meta, but it's tier two cloud customers, a company that may be filing for an IPO called CoreWeave, and also Tesla's XAI. They bought probably about $1.5 billion in equipment from Supermicro this past year.
And Wooj, to your point about the analyst coverage, I just pulled up the ANR function for analyst recommendations. Most or a lot of the analysts have suspended coverage or not rated is kind of what we see. So of the ones that do have a rating on there, 3 buys, 7 holds, and 2 sells. So it sounds like this company has a lot of ground ahead of it to rebuild confidence from the analyst community, probably their customers, and from investors. Is that kind of your thought?
Yeah. Yeah, I mean, look, I think some of the headline risk has been eliminated for now, or at least extended. They only received an extension from the NASDAQ. The next milestone, quite frankly, is probably February 25th, when if they don't file their filings on time, by that time, the delisting questions will start arising again. They essentially kick the can down the road.
This might be a super silly question. At one point, I probably knew the answer to this. But where does Supermicro sit in the AI play stack?
Yeah, so they're actually in the server space. Okay. It's the hardware equipment that helps run the models. Among the U.S. vendors, they actually had the largest amount of AI server sales, larger than Dell and larger than HPE.
So they're very much like needed in this market. Like it's going to be hard to replace them either way, right? Like they're a needed essential.
Well, that's a good comment and good question. Competition has grown. Dell has actually strengthened their AI chops quite a bit. But I came back from a couple of conferences recently, and we're starting to see other companies with similar capabilities that will be making it much more competitive. And one of the evidence there so far is the lower gross margin. They peaked their gross margin at around 17% a couple of years back when they were the sole player. And now that you have more players coming in, their gross margin in the last couple of quarters went to about 13% and 11%.
Wow, I'm just looking at the DES function. March 19th of 2024, the company sold 2 million shares at $875 per share. Goldman Sachs, thank you very much. Jin Ho, thank you for joining us. Jin Ho is a senior technology analyst for Bloomberg Intelligence. I mean, that is just amazing.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.